All right, thanks everybody for joining us today. This is going to be recorded, and one thing I say at the very beginning of all of these is if you're not familiar with this strategy or with the way I teach it for that matter, watch it again so some of the nuances stick in, because these butterflies are tricky, and as much as you can go online and like read how to set up a butterfly, it seems pretty easy, but with my rules that go into it, it's going to help you increase your probability of success. And if you just go out there and do it yourself, you can really set yourself up for disaster at the onset. And I actually found a pretty good example of one that will show you that if you set it up improperly with the wrong nuances involved, or you don't follow my rules with this, it could really be a bad situation at the onset. So we're going to go through and try and make some rules around this and increase your probabilities of success with this trade. Let me go over a couple of things real quick. My name's Eric Wilkinson. You guys may recognize me from CNBC, Fox Business, or the Wall Street Journal, where I've commented on everything from economic to geopolitical and market analysis. I started trading in college with a psychology degree with some money I had earned. I'm in high school and in college, and talked to a banker there, and he was like, why don't you start doing some discount brokerage? And I decided to start trading then and switched my major over to finance. And then after graduating from college, I moved up to Chicago and started working on the floor of the Board of Trade. I actually just walked around the floor and asked people who were hiring. That's how I got started as a runner and moved up into the pits and started trading from there. But I'm not here to tell you I'm going to make you rich or make you a millionaire, but I am going to help you take control of your finances and, most importantly, manage your own risk and likely increase your probabilities of success. Anyway, traded most markets throughout my career. I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all of these products in all market conditions. And I've got to go over this disclaimer really quick. It says, any opinions, news, research, and analysis, or other information contained here are material provided by ProTrader Strategies and associate companies, is to be provided as general commentary and does not constitute investment advice or solicitation to buy or sell any of these securities or strategies. Basically what all this is saying is, you guys, for one, we're here to educate you. We're here to teach you how to swim. We're not here to swim for you. And the other thing is without knowing your risk parameters, without knowing what's in your portfolio, I could not possibly tell you what is appropriate for you. So take what we're teaching you here and decide whether or not it is appropriate for you and implement it into your portfolios in your own way. And the bottom line is, do your own homework. Remember, past performance of any trading system or methodology is not necessarily indicative of future results. Another thing is you can follow us at Twitter, or follow us on Twitter. You can follow me particularly at Wolfman's blog, and you can follow our parent company, ProTrader Strategies, at ProTrader Strat on Twitter. So ProTrader Strategies throws out a lot of deals and stuff like that on different webinars and things of that nature, and I throw out a lot of snark and or commentary on overall markets. Some of the trades that I'm doing, especially like right now in earnings season, I'll throw out what my earnings trades are for the most part. Sometimes I'll just throw it out there. You kind of have to know what my rules are around those strategies in order to set it up, but it should be pretty intuitive. Anyway, this is going to be on the long put butterfly. Now, this is the last in the segments of regular butterflies. Next one we're going to be doing is on the broken wing butterfly, so stay tuned for that as well. But this is the long put butterfly. And the reason why you guys have to know all of these and know the different rules, and even if you have like a whiteboard up on the side next to your desk or a bunch of sticky notes, write down these rules and make sure you follow them, because you don't want to be a one-trick pony, and not every situation calls for like an iron condor or you know, a butterfly or a call spread or things of that nature. Make sure that you kind of look at it, check different strategies around the same underlying if it's all high implied volatility, and kind of do a little soul searching whether or not you think this is going to move very much. If it's going to, you think it's going to move quite a bit, then you probably don't want to necessarily do this long put butterfly. You might find a different strategy to put around it. So a couple of people are asking some questions here, and I'll get to those before we dive in real quick. What are the long put butterflies? Oh yeah, we're doing long put butterflies. And we did the calls last week, yes. Looking forward to the session, thank you. Did doing psychology as discipline help you in trading endeavors? I used to say on the floor that psychology probably suited me better than even my finance degree as a trader on the floor, just knowing psychology of people and how your emotions work when you're putting a trade on, and, you know, trying to separate myself, and you guys should do this too, separate yourself from the money. It's, you know, you have become a real trader when you don't look at wins and losses as money. It's when you look at wins and losses as probabilities and whether you're beating probabilities and things of that nature. That's when I feel you've kind of blossomed as a trader, for lack of a better phrase. But when you start thinking about, you know, I'm losing money, and you're constantly thinking, you know, especially with options, because options have a tendency to make you think you're losing money immediately. And that's has to do with, you know, everything that's involved with them. So as long as you can wrap your brain around, you know, I put this on with this probability and follow those probabilities to the end of the day, you will surely stop thinking about the money so much, and the money will start coming in. When you start panicking and doing things like that, or you start seeing all of a sudden this trade was a loser and now it's a winner, so, or it's a scratch and you get out of it, you know, look at it as the probabilities and playing those probabilities, and you'll do much better. So great question, Luke. I need to find my glasses. Sorry, guys. Do you see much downside to selling covered calls? What is the opinion on selling covered calls? Great question, Wayne. I've actually done a webinar on it, so check that out, because I don't really want to take all the time about covered calls, but I love covered calls. And as a matter of fact, that's what I first started trading when I was in college. I bought some stocks and then started selling calls against those stocks. So I champion, especially people that have a lot of stock in their portfolios, is to lower the basis. So that way. All right, so let's get on with this. And then the long put butterfly here, market assumption is the market movement should stay inside the wings. And one thing you're going to notice with the long put butterfly, as with the long call butterfly, a lot of times it's a little easier to build this strategy on the put butterfly as opposed to the call butterfly. That's because it has a tendency to have more inflated pricing in those options montage. So put butterfly, sometimes if you're looking at the call butterfly and it's not really working, you can kind of flip over to this other side and look at it as the put butterfly, because really our assumption is the same, that we want to stay within those wings. So whereas the short call and put butterfly, I talked about the different scenarios around that and why you would want to actually stay with a call butterfly or a put butterfly. This one, since it's going to be hopefully staying right where it is, it doesn't really matter so much if it moves in one direction or the other. And to set up this long put butterfly, basically you're just squeezing two put spreads together to create the butterfly. So we're buying one long in the money put, selling two short at the money puts, or as close to at the money as we can. This is where you might have a little bit of directionality. Maybe you want to put this on because it's high implied volatility and you think it's going to move to a certain strike. Well, you could, if you were using like a Fibonacci level, or maybe the market profile, which is what I usually use, then you could maybe look at those puts that are right there at the point of control, if you will. So because that's usually where the market will kind of settle down in my eyes. And then you're buying one out of the money put. So all in all, this strategy is appropriate for IRAs. So I know a lot of you guys trade in IRAs. This is also appropriate for somebody that has a smaller account size, because it doesn't take up a lot of margin. But at the end of the day, it will work in the IRA as well. And so Luke's saying, this long call put butterfly is a low probability strategy. Could you still emerge profitable in the long run on this strategy alone? Luke, I would have to say that this is a very low probability strategy, and that's why I'm saying you need to really kind of look at the rules around this in order to increase your probabilities of success, because one of the things I talk about is we're not going to want to pay very much at all for this. That's why we need to have high implied volatility in this environment, because you can set yourself up for disaster in the beginning. But I'll get into some of those details here in a minute. But I would not ever go and use any one strategy, even 50% of the time. So probably the most I would allocate for any one strategy in a portfolio would maybe be the maybe 25%. But at the end of the day, you're probably looking at maybe 10% in any one particular strategy. Try and use a lot of different ones. Don't be a one-trick pony, because if you are, you're beholden to that strategy. So no, I would not say you could survive on just one strategy alone. The highest probability one would probably be the strangle, but in that regard, I wouldn't say put all strangles in your portfolio, because it's unlimited risk completely. So in that, if something big were to happen, you're going to blow yourself out. So mix it around constantly, kind of filter in different things according to your assumptions on that particular one underlying. Does that make sense? Can I name the main strategies I use for trading options? Yes, I usually, my strangle is usually the go-to strategy for me if I see high implied volatility, especially around earnings. But if I have a directional assumption, like I had with Amazon, I thought Amazon was going to go up, so I sold some puts in it because it had the high implied volatility. I was looking for that crush, but it all kind of plays around earnings. But again, the strangle being my go-to, or the one that I like the most, I still am not going to have my entire portfolio as strangles. There's no way. For the strangles, I sometimes, if I'm worried about, so for the strangles, do you sometimes define the risk, is what Luke's asking. And being like an iron condor, yeah, if I'm not super sure about the strategy, or it not moving outside my strangle, then I will define that risk. And I also have done webinars on that as well, so check that out. All right, so keys to success, picking the right underlying. First thing, utmost importance for the most part, is picking the right underlying. Don't pick something that has a wide bid ask, because you're setting yourself up, especially in this one, because there's 4 different legs in a sense, right? We've got the in the money put, we've got the 2 at the money puts, and the 1 out of the money put. All of those bid asks, if you have 25 to 50 cent wide bid asks in there, you're going to get chopped up getting it out of this strategy. You're going to have to give up too much edge to get in, and you're going to have to give up too much edge to get out. So that will eat up your overall yield. So another thing is use all different kinds of underlyings that you have at your disposal. Make sure that the bid ask when you're implementing this strategy is pretty tight. What I have as a rule of thumb for this, $100 stock or less, I want that bid ask to be about 10 cents wide. And another thing is if it's, a $300 stock or whatever or higher, then just look at it like if it's a $200 stock, you just move the decimal points 3 ticks to the left and you got 20 cents. So a $200 stock should be like 20 cents wide or narrower. So don't go outside that. And, I have a couple of stocks that I actually bend that rule on, GDXJ, which is the junior gold miners. But I know that there's a lot of people in there, and we used to call them on the floor, they're in the weeds on some of those wider ones. But that being said, you don't necessarily have to go to the mid-market or give up too much edge. You just kind of better the bid or the offer, and you usually get hit. So make sure there's a lot of participation in the underlying you're playing around with, especially when you're learning. Don't go out and trade like AutoZone, which has super wide bid ask, or I think Hertz is another one that everybody's probably heard of, but just there's not a lot of participation in that underlying. And then Altera, which is ticker symbol MO, which not a lot of people even talk about, has like, 1 or 2 cent wide bid ask. So try and find those kind of stocks where there's a lot of participation in them. All right, so picking the right strikes. Now with this one, this strategy in particular, picking the right strikes is very important. And the other thing is the right environment. These are probably two of the big things that are going to determine whether or not you are successful in this. So for a rule of thumb with picking the right strikes, basically I'm looking at like a $50 stock. We're probably going to be doing $2.50 wide, and if it's around a $100 stock, we're going to be doing about $5 wides on our wings. So in that, we want to we want to pay a debit on this, or we're going to have to pay a debit on this, but we want to pay a debit on a $5 wide, let's say, about $1.60, and on a $2.50 wide wings, that's from the at the monies to the in the money, or the out of the money ones, the at the monies to the wings. On a $2.50 wide wing, we want to pay less than basically like 80 cents. So the idea here is you're risking 1 to make 2 ultimately. So your max profit would be ultimately 2 times what you were risking. Okay, so if you're paying $1.60 and it's $5 wide, it's $3.40. So it's pretty close. And I am obviously going to the paying less aspect of that, a little bit under paying 1 to risk 2, or risking 1 to make 2. Because I think when you add that all up, it comes about $4.80 or something off the top of my head. All right, so picking the right duration. Usually we want to kind of implement this when there's less than 35 days to expiration, because remember, we're trying to nail the number on this in a sense, and nailing the number is we don't want it to move. So where we're picking this strategy and putting this strategy on, we don't really want it to move very far at all. So we've got to nail the number, and the longer duration we have, the higher probability is this market's going to move, right? So we kind of want to have a narrower expiration cycle. So we want to get inside this 35 days, and we want to get this decay to happen so that our wings decay rather fast, because the at the monies, if we are nailing the number, aren't going to decay as fast as some of those further out wings that we have. And then picking the right environment. With this one, this is the other that I was talking about, picking the right strikes, picking the right environment are really important in this one. We want the right environment to have high volatility. Of course, we're in a situation right now where it's very difficult to find high volatility stocks, but we need, this is a hard rule of thumb. Implied volatility percent in that underlying needs to be above 50%. The reason why is if implied volatility expands on us, it's going to hurt. We want the implied volatility to contract, and that way we can get out of this strategy much quicker. So make sure you try and pick as high a volatility as you can. Yes, that does, volatility says, this market's going to move, but it doesn't always work out that way. As a matter of fact, when implied volatility is high, it has a tendency to revert back to the mean, right? Same thing as if implied volatility is low, it has a tendency to revert back to the mean, meaning it's going to go up. If implied volatility percent is like 0, yes, it can stay at 0 for an extended period of time, but the probability is it's going to start increasing. So we don't want to be in a situation where the probabilities are not in our favor on implied volatility movement. So make sure we're trying to pick high implied volatility. Maybe it's had a big move and you expect it to kind of settle down. That's when we would want to implement this particular strategy in the long put butterfly. Also, the other thing is with this picking the right environment, if we have high implied volatility, that means we're going to ultimately pay less for this strategy, and that's what we want. If you pick something in a low implied volatility situation, you're going to end up paying a lot more for this, and you're probably going to end up paying, sometimes you can pay almost the width of the strikes. If it was $5 wide, you could end up paying $4.70, which means you set yourself up to lose money immediately at the onset. So that means you're risking $4.70 to make 30 cents. That doesn't make sense. You cannot do that. You got to follow those rules. $5 wide, you're paying $1.60 or less. $2.50 wide, you're paying less than 80 cents. All right, and then knowing our exit strategy before entering the trade, along with my rules of this being a low probability trade, we aren't going to be expecting to make the entire max profit potential on this. So if we were looking at a $5 wide and I paid $1.60, right? That means we're risking $1.60 to make $3.40. Well, I'm only going to look to take about half of what my max profit potential is. Or another way to look at it is 2 times what you paid for it. So if I paid $1.60 for it, I'm going to be looking to get out of this strategy at like $3.20 when I'm buying it for $1.60, and when it says you can collect $3.20, that's when I'm pulling the ripcord to get out of that one. Does that make sense for everybody? What if you sell 2 different strike puts instead of 2 of the same? That would end up being, that's a different strategy altogether. It would probably widen it out a little bit for you where you could do that. And I'm trying to think of what that strategy actually has a name, but I got drawing a blank on it right now. But yeah, you could do that. I don't usually, but you could do that. I'd have to look at that a little bit further. I'm not in that mindset right now. Sorry, Luke, I can't really do it that. What is that? That's exactly what it is. It's the Condor. Yes, that would be the Condor. And I kept wanting to think it was an iron butterfly, and I knew that wasn't right because that's a straddle with the defined risk. That is just the Condor. You're right. Which is better? Well, I would say that, with the Condor, I don't usually use the Condor, to be quite honest, but so I wouldn't be able to say what the probabilities are on the Condor. I'll have to look at that a little bit closer. I do it every once in a while, but not a lot. And the thing is, when you're taking away risk, you end up taking away your reward as well. So this is a higher risk strategy, so there's higher probability of reward. So that's why I kind of like this one. But that Condor, you're kind of stretching it out, and you're taking away risk, but you're also going to have to pay more for it. All right, so max loss is with any debit strategy. Anytime you pay a debit, your max loss is that debit. So that's rather easy. And then the max profit on this is there's really two ways to figure it out. The easiest way to do it is taking that in the money put, subtract it from the at the money put, and then subtract your premium paid, which is what I kind of talked about with that $5 wide, kind of what your wings are width apart. That width apart minus the premium you paid, that balance is what your max profit is. You got two break evens on this because it can go in either direction. So the out of the money put plus the premium paid, or the in the money put minus the premium paid. So if it was like the 45, if you did the 45, 50, 55 butterfly, you paid $1.60 to get into this trade. The out of the money put is the 45 strike plus that $1.60, so your break even is $46.60, and then the 55 minus the $1.60 puts you at $43.40. So on the upside, off the top of my head. So I wanted to throw in an old example of what this setup would look like, because I was finding it very difficult to find some good setups in this environment. So this is an old example of that I found, and this is what I'm talking about. We've got a $2.50 wide strategy, being the 67.5s to the 70s, and we're only paying 64 cents. So that's well below my 80-cent limit on this strategy. So that's much better. That means we're risking less in order to make much more. So that's what we want to do. And this would be in this would have had a very high implied volatility. So that is why you want that higher implied volatility when you set this strategy up, because you're paying a lot less. And in that, if you're paying a lot less, you're risking a lot less. Does that make sense for everybody? Which gives a higher yield, the call or the puts? The puts will generally give you the ability to pay less in order to make more. So I don't know why this says call butterfly. Is that calls? Oh, that is a call. Sorry guys, I pulled this from a different slide, but this ultimately is what we would want to do, set this up as if it were puts though, and try and get where we're only paying less than that 80 cents. Sorry about that. All right, but the calls and the puts usually have a tendency to kind of look very similar. All right, so this is when I usually talk about, throw it out there in the questions box, how we've been going back and forth. Please throw out there some stocks that you guys want me to look at. ETFs, that's the other thing with ETFs. We want above 30 IV% here. Anything below that is not going to work out very well, I can assure you of that. So I got a couple of questions going on. The puts, I answered that one. How many days to expiration when you put this trade on? I usually try to look at inside of 35 days. I don't think we're going to be able to do it very well with 14 days. I don't think we're going to get it to work out for us. But usually inside of 35 days, but this is 20 days past, so it might be difficult to set that up that way. So Amazon, right off the bat, they just had earnings, so they're probably getting volatility crush right now, which is this whole thing. So like, you know, it's getting eaten up. So what is their implied volatility percent right now? Probably in the 30s, it looks like, off the top of my head. Yeah, so 29. This is where you look for that implied volatility. Current implied volatility percent is 29. We can try and do it just because we don't have a whole lot of choices today. So let's look at the puts. The close, it's trading 8, 10, 30. So this is the closest ones to do it with. So we want to sell 2 of these. So you can also go up here and set it up as as a butterfly right here. But I like to build it out myself, just because, especially with a $800 stock, we're going to probably be going like $20 wide or something like that. So let me get a couple more on here. So let's go to like 30. So, all right, so we're going to be doing the A10s, and we want to sell 2 of those. So we're going to sell 2 of those and then go about $20 wide, just because at first blush, I think that's probably going to be about right. So $20 to the upside, and then $20 to this side. And one of the things to look at, I talked about 10 cents wide, but this is an $800 stock. So if we move the decimal place 1, 2, 3, 81 cents would fit my rules on this. And look at that. It's 45, 55 cents wide. So that fits with that rule. Plus, there's so many people in Amazon that you would never go at the mid price. I would start, since we're paying a debit on something like this, go a little bit lower, maybe 10 cents lower, and then enter that trade just to see if somebody comes in and hits us. And then it doesn't cost you anything to go in and cancel, replace this order over and over and over and over again. All right. I'm not saying you wait like 5-10 minutes, but put it in, and by the time you go in there and go through the steps to cancel, replace the order, you should be filled if you're going to be filled, and then work it up. But if you go in there immediately and get hit on this, as soon as you entered the trade and all of a sudden, ding, you got hit, then you probably gave up a couple of pennies. And that doesn't sound like a lot, but over the course of your life of trading, that is a lot of money you're giving up. And especially when it doesn't cost you anything to put an order in and just let it sit for a second, cancel, replace, do it again and again and again. Does that make sense? All right, so yeah, a lot of people throwing them out there. So this would, this kind of works, and because they just had their earnings, I would expect them to kind of settle down. We could probably see a few more days of volatility contraction in this underlying, and it fits the rules, right? We got $20 wide, and we're only paying just over $5. So if we look at this on the Analyze tab, it's going to have a very nice risk reward on this. So, for instance, we're risking $5 to make that, should be closer to, I guess it's slightly under 1,500. So that is a really good risk reward for this one. And, I might bend the rule on that volatility, implied volatility percent for this one, just because they just had their earnings. And I would expect this volatility to continue to go down lower, like where these lows are probably after their earnings. So if that was your assumption, then we could look to implement this, because it looks like it has a little bit more to go before that is done going down. So that would be one of those times where you might be able to bend that rule. But don't ever bend the rule on how much you're paying for this strategy. That is a hard line rule, because otherwise you're going to hurt yourself. All right, so on to a couple other ones. So Amazon might work if you thought volatility was going to continue to go down. Then on to OPH. He's got a bunch, or she. So Baidu is one of those also that has a tendency to have wide bid asks for $175 stock. So I rarely trade this anymore. It does have a lot of open interest and a lot of trading going on in there, as you can see. And some of the stocks are a little bit tighter, but just don't, for this one particular, you know, sometimes you can get better fills in it. And this is one of those stocks, like I was talking about, that people are always in the weeds, it seems like. So just make sure that when you're playing around with Baidu, that you don't resign yourself to making sure you get this trade on with Baidu, or any trade on for that matter. Make sure you get away from that mid price and slowly increment up, but don't give up too much edge on this, because we can show you to get in and out. I'll just do it as an example to show you that getting in and out. So we want to sell two of these because it's close to 75, and then we're going to probably go about $5 or $10 wide on this one. So let's just start out with $5 just to make life easy. $5. And the other thing is, when you set this up with the auto setup, it's going to give you the $2.50 wide butterfly. That just doesn't end up working out. So $1, you're paying $1 to get a little less than $4. Let's look at it's got a 10 IV%, so you might want to go and look, and they're probably having, when are their earnings, do you know? Looks like their earnings are probably coming up pretty soon. So their earnings are just around the corner. It would be just outside of this particular montage that we're looking at. So you'd still have to worry about implied volatility starting to expand on you. So I'd probably go away from that one for that reason. And the other thing is look at this. So the mid price is $1.16, and it's about 70 cents further to where all the bid ask lines up. So you're giving up a lot to get in, and you're going to have to give up a lot to get out, especially with this strategy, because there's so many legs. All right, so Tesla is another one somebody asked for, I think. Let's delete that one. And here's another example. So like with Baidu, we were just looking at this one, 250 cent or $250 wide. So we'd want, Tesla's usually tighter than this though too. You usually see Tesla have a lot of participation in it, and you don't have to give up that much edge. I find it in Baidu, you have a tendency to have to give up more edge. But Tesla, I think, is going to have low implied volatility right now too. So it's 11%. So, and they're going to have earnings coming out soon. So I think that volatility is going to start expanding in there. Amaro is saying Met. Didn't that come in? So Met just had their earnings. Looks like, so this looks like it's an outlier that I might discount. So it's going to probably look like they have a high IV %, 37. It's still below that 50. I would say that just based on this chart, that one slam afterwards, after the earnings, is kind of one of those things, kind of like in diving, they throw out the high and the low when they're just way out of whack. That would be something I'd probably throw out and look at that as being the basic low, and we're right there. So I'd have to say that's closer to like the lower should be like an IV percent of about 5 or something like that. One thing to note with the IV percent, the way that this calculation is done is you have a numerator and a denominator, and you take where it is currently trading, which is 0.25, minus the low. So if I went where I think the low is right here, so 0.25 minus 0.23, let's say. So in the numerator, you would have 0.02 divided by the high, which since there's two of them, I would say that this would kind of fall in line with that. But for math purposes, let's just say 50 minus that 23. So we've got 27. So 2 divided by 27 is, or 0.02. 0.02 divided by 27 is going to give you, oops, sorry, right, 0.02. Oh, yeah, you know what, that's why I did it, because I did it 2 divided by 27. I did it without the decimals. So it's 7% IV percent. So you see how I did that? Everybody follow that on there? When I look at IV, I just look at IV percent. Somebody, you're asking if I look at historical IV or IV percent. I usually just look at IV percent. And then, sorry, can you repeat the formula for IV percent? Yes, it's, so you have a numerator and a denominator, right, in the division thing. So in the numerator, which is on the top part, you take where it's currently trading, which is 25. Let's just say, we're just saying percent. And then where the low is. So they're calculating this as the low. But I'm saying, you know, sometimes you can take out those massive outliers that just don't make sense. So, I mean, even though that was on in earnings, that just really slammed down. So I would say that normally, historically, it kind of comes down to about here. So you take the 25 minus the 23 and you get 2. So that's in the numerator, the 2. And then you take the high, which is just, I said for math, say it's 50. 50 minus the 23 is 27, right? So that's in the denominator, 50 minus 23. So you take your 2 divided by the 27, which is the sums of those two, and you get 0.07, which is 7. It's in an IV percent of 7 IV percent, instead of 30 something that it's saying. See, it's saying it's at 37 IV percent. And that's important to know, because I do that a lot too. If I'm looking at that, I don't want to just look at this and not know where I'm coming up with that number, because it can be misleading. And that is a perfect example of how numbers can lie, in a sense. All right, so Goldman Sachs was another one. Oh, did I look? Yeah, so I'm going to discount MetLife. So Goldman Sachs, they're in a low percent. I'm going to throw out one. So I always do this. I go into the gearbox, put my IV percent up here, and load it from high to low. And as you can see, there's nothing up here except for Brad, and I don't even trade that anymore. But let's look at Lulu. Because Lulu is the highest one without earnings. So let's look at Lulu for, and as you can see, it has a outlier also. Let's look at it anyway. All right, so let's do the puts, because Lulu always has good markets in it. So we want to go and we want to sell 2 of these, and okay, so that's probably we could probably actually go to this one, get a little bit more. It might make it a little bit better. And then we're going to try and go about $2.50 wide and buy that one, and then $2.50 wide to the upside is 9. Okay, so we're paying a 73-cent debit. So, you know, assuming that we would think that Lulu had high implied volatility, this would fit that rule. I want to show you one where it won't fit the rule that I found. And this is why, like IBM. So when I talked about the other thing is you want high implied volatility, so you pay less for it. So the higher implied volatility ones, you're going to pay less. So IBM has pretty low implied volatility. As a matter of fact, it's probably at the very near bottom. Oh, IBMI, sorry. So IBM should have pretty, I think it's 14. So when I was flipping through this earlier, so the closest is probably the 75 strike. So we're going to sell 2 of those and then go $5 wide on something like this. So $5 wide, let's go to the, and then the 80s to the upside. So $2.40. So that's not nearly as bad as what it was looking like earlier. But again, you know, it's getting very close to that. As a matter of fact, oh, you know what I did it in? I looked at, so I was playing around with it. I think I looked at it in the March. So let's do it again. So if we went further out with low volatility, a highly improbable strategy. So we want to sell 2 of those, go $5 wide, and buy that one, and then buy the 80 strike to get it wide. And that one's working out. Of course, let's just see what it would do in the put or in the call side, just to give a bad example. So we want to sell to, sorry, we want to sell to, buy one, buy one. Okay. I don't know what was happening earlier. I was getting something where it was, can't remember exactly what I did for the bad example on this one. But I was setting it up, and it basically, I had a strategy underlying where I was paying like $4 for this same strategy. And I thought it was IBM, but it might have been a different one when I was kind of trying to find one to vet for this strategy. But yeah, you can set yourself up where you're paying even over 50% of what the width of those things are. And sometimes you can do it where you're paying almost the width of the strikes, which completely sets you up for disaster right away. Stock has to stay between the 2 long strikes in order to be profitable. Yes, it actually has to stay a little bit inside of that yet. But for the most part, the less you have to pay for this, the closer to the wings or the outside legs is where it's got to stay within. So correct. So the wider the better. And the other thing is with high implied volatility, it allows you to get those wings really far away from where it's trading. So you increase your probabilities of success there as well. So something with a really, let's just look at something and assume that that they didn't have an earnings. So something like Cisco, let's see, they don't, it's not a very good example because they're wide. So let's look at NVIDIA. So so with this one, I mean, I'm sure they have earnings coming out pretty soon, which is why they're the only thing that has high implied volatility. And so for this one, the closest to is probably the 14. So we could sell 2 of those and then go $5 wide on this, which is to the 9s. And then $5 wide to the upside is the 9s. So 62 cents. So you can see as the higher implied volatility we're getting in these strategies, the less we're paying immediately, which is what we want. So, you know, you could almost even go then and try and double it. So, so we go to the 24s, add $5 more to it just to see what it looks like, the 24s, and then go down to the 04s. So now we have it as $10 wide. So $10 wide, now we're risking 1 to make 3 in a sense. So it's about the same, but at the end of the day, if we go to look at analyze the trade, let me get this down so it's reasonable. You can see we're risking $250 to make $750-ish. So, and look how wide our wings are now to the outside, very close to the outside. So in a situation where there wasn't an earnings, but I would not put this strategy around in earnings necessarily, unless you thought it wasn't going to move anywhere, which has actually been happening with the earnings that we've had. They've stayed well within the market maker move, but you know, as long as your payout was more than what the market maker move was, then it might work, but I usually stay away from that. Does that make sense for everybody so far? How that works? So as you can see, higher implied volatility allows me to get my wings way out there, close to the standard deviation move in a sense, and we're not risking very much compared to what our reward is. We have a lot of room to move before we get to our break even. I mean, this has got to move $7 to the downside and about $7 to the upside. So that's a pretty big move. Even for NVIDIA. All right. Anybody else have any last minute questions? I think I pretty much went over that, but it's a little easier to set this strategy up if you're kind of like thinking you want to do the long butterfly, if you will. I would always opt probably towards the put butterfly just because those have more premium in them usually. So I would kind of opt towards that. With the call and the put, remember the call and the put, short butterfly, you know, you're counterintuitive to what you're actually setting it up for. So if you have a call butterfly, you actually want it to go down in a sense, and if you want a put butterfly, or if you want it to go up using the put butterfly, or you'd use the put butterfly for the shorts. And yes, Ed, this is being recorded, and like I told everybody, please remember, watch this again. Any adjustments if this trade goes wrong? Andrew, great question. No, because anytime with the debit spread, I know my risk getting into it, and I usually am not going to mess with it. And that's another reason why, you know, you want to risk very little to make more. So if it does make that big move and goes outside my wings, I didn't risk that much in the beginning, and it has the probability to come back down. So that's why we're playing it that way. All right, so hey guys, we're doing the 1 month trial for $7, and you can take advantage of all those, like we've talked about all these different strategies and everything else with the iron condors, the covered calls, because if a lot of you guys have portfolio with calls in there, it's a great deal for $7. I mean, you can't go out to lunch for $7 and you get this all for a month, and there's well over 50 videos now for the trading workshops, which is these short, quick kind of refresher courses on the different strategies. I don't go into a lot of detail and a lot of examples for those, but those are out there. You also get priority access to the online live workshops, which is what these are. So you get that included in there. Also, you get the daily market commentaries where I talk about what economic news there is, what I kind of foresee in the geopolitical stuff, and I run over all the economic data I said, and all of my trades. So I talk about every single trade I put on. I talk about how I'm managing that risk and how I'm staying mechanical if something goes against me, and I talk about the earnings trades in there as well. So I talk about every single trade I do. You also, which isn't mentioned here, get access to me. So if you guys write me an email saying, you know, hey, I've got this trade going against me, what do I do? I can tell you what my rules are around that strategy. So if you're watching this delayed or on tape, you can see this is the link right there. If you guys are participating right now and you guys have enjoyed what I've done, and if you've taken anything at all away from this, as much as that may save you, $7 is for sure going to save you on the rest of it. Click on the link in the chat box there. So all these courses are designed to help produce consistent winners using any one of these techniques. At the end of the day, it's all about probabilities, and I talk to you and teach you how to learn those probabilities. And you also get access to the trading courses for free. So take advantage of this. This is like the best deal ever. And like this trial could pay for itself on your next trade, for that matter. If you've been setting up something incorrectly, like they put butterfly or something like that, if you've been paying too much for it, not having the probabilities, at $7, it just paid for itself for sure. You also probably pay that in a day of commissions for any one of your platforms. All right, so take advantage of all of this, and it's in that chat box right there on the side, not the one we're kind of going back and forth with, which is the questions box, but in that chat box there to the side. All right, so this is also, you can write this down if you want, or like I said, click on the chat window. But if you're watching this on the tape delay, then you can just write it down. Later webinars, we're going to be drilling down on option components and trades I find, when and where I find them appropriate. Also, if you have any questions, you can reach out to us at 310-598-6677 or email us at trading@protraderstrategies.com. So if you want to write that down, you can pause the recording if you're watching this on delay. So this service includes all your trade strategies. Yeah, all my rules for the trade strategies. Yes, it does. So far, there's a couple of them that I haven't covered yet, but I would say probably 90% of the strategies out there that I trade are already, I've gone over on them. So, are you holding me up to the public ridicule? No, Rick, I'm not. We'll give you the shout out though. Do you ever trade the SPX RUT and NQ? Yes, I do. Absolutely. And all of these rules will work with those as well, Stan. So, you know, if you don't find one specifically associated to SPX, you can definitely take the rules and apply them there. Rick, you've been kind of quiet lately. All right, that's all I got. You guys have a great weekend. Oh, also, I'm going to be at the Coliseum course, or the Coliseum number 16 at the TPC Phoenix Wasted Management Open. So if you're on Periscope, check it out. I'll be doing some live coverage. All right, that's all I got for you guys. If you can't take that, take it easy. Thank you guys. Appreciate it. Have a great weekend. Take care.